Welcome to Trading Nation. I'm Brian Sullivan. We're joined today by business cycle expert Lakshman Achuthan. He is Chief Operations Officer at the Economic Cycle Research Institute. They look out and try to predict what's going to happen, not what has happened. Lakshman, great to chat with you again.
You too.
With the crazy market ride of the last, call it, week and a half, I want to ask, is there anything that you're seeing that would lead you to believe we could be in for an economic shock or slowdown in the second half of the year?
Well, slowdown, certainly. We really are seeing pretty convincing signals from our leading indicators that there's an economic slowdown in growth, a deceleration in growth that is on tap for this year, maybe even before the second half. And these are the same leading indicators that anticipated the run-up that everybody's so happy about, that we had last year, actually starting even in 2016. And so those indicators, which nailed that call at a time, like a year ago, if you remember, everybody was saying, the hard data is not corroborating the soft data, so we can't believe in this recovery. And our indicators were taking off most optimistic really since 2010. And that was a good call. Now those same indicators all rolled over and are pointing to what we call a growth rate cycle slowdown. It's a deceleration in growth, and it'll be alarming, I think, in the sense that it's the opposite direction that everybody's expecting. It's not a recession call. There's no recession in sight, but everybody is kind of extrapolating the strength, the momentum, to use a word that's out there, from 2017 into 2018. You got the tax cuts on top, so it must be good, but actually, the cycle itself is going to be decelerating this year.
And we've been looking a lot at the bond market. And tell us why you are specifically focusing on good corporate credit and high yield and the chart between them as some kind of an indicator. What does it mean? Why are you looking at it?
Absolutely. Some people say the bond market's smarter than the stock market.
The bond people say that.
The bond people say that. The stock people say, get out of here. Everybody knows about the yield spread. You know all about those things. What we're really interested in here is what you're talking about. It's the quality spread between BAA, corporate investment bonds, and high yield debt. And when you look at the quality spread, what you see is that it turns down. I have it on the chart so that when the spread widens, it's pointing down. And it's been widening since spring, since May of last year. And that's showing a signal from a very liquid, very smart bond market keying off of some concern about relatively higher default risk as the economy slows. And this happens every time we have a slowdown, and it's corroborating what we've picked up in our leading indexes. And I think it's a really interesting signal to keep an eye on here.
And then when do we, I don't want to say hit the worry button, but at what point on that chart do we start to, maybe start thinking about something not quite as good, like you talked about, a slowdown?
Well, it's got to get quite a bit lower. Look, the spreads are really tight.
It's just something to watch at the beginning, maybe.
Well, it's the beginning. They peak. I don't think people realize that this quality spread peaked last spring, and it's been slowly deteriorating. It's accelerated a little bit here. And so when we are watching coincident data on production, employment, income, and sales, I think it's going to start rolling over, kind of like what you're seeing there. On this chart, each of those troughs, those are the bottoms and the slowdowns that we've had. We've had 3 slowdowns since the recession. We had one in 2010-11, we had one in 12 into 13, and we had one from late 14 into early 16. And each of those slowdowns saw GDP go down by a couple of percentage points. So let's say we get the tax boost from the tax cut in this year. It's probably on the order of a 0.5% positive boost to economic growth, not profits. Economic growth lifts it up a little bit. But if you're looking at a slowdown of a couple percent, it's not enough to offset it. So I think where people are going to be talking about this as the year progresses. My fear would be if the Fed got a little too hawkish based on any near-term inflation stuff into a slowdown. That combo is not a great combo.
Okay, Lakshman Achuthan of the Economic Cycle Research Institute. Something to watch. You're on the record. We're on the radar.
Well, you got it.
And certainly watching that one chart you brought for us, Lakshman. We appreciate it. Thank you as always.
Thank you.
All right, guys. Thank you.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.